Now this is what we're going to be doing for this is what we're going to be doing for an initial opening trade. Remember, if we do have to do adjustments, that is fairly easy to do once we have this position on. But it's critical to understand adjustments, because if the price gets very quickly to our upper side of our break-even points, up to the around 150, 151 level, then we need to do some adjustments here. Or if it goes down to our 125, 126 level, we need to do some adjustments there as well. But this is how we set up our initial position. We really want this center line here that you see, 138.48, is our live price. That's the current price. You can see it here, and if you click on underneath the delta sign, you see this little wrench. If you click on that, you can also see what the current price is, 138.48. And that's all we have to do, really. All we have to do is just right click on this. We are going to confirm and send it. And we are going to send that off to the market and see if they give us our price. If we go back to our trade tab, and we are going to try, they are working on it now. Let's take a look. Okay, the current price moved away from us. This is what happens sometimes. You know, we put it in at 498, and now the market has moved a little bit against us. It's at 499. So we're a penny off of the mid price, which means that we're probably not going to get filled on this. But you know, we'll see what happens. If we need to, we'll go back in a few minutes. Now it's moved again. It's moved up to $5. So, yeah, we may not get the prices that we want here, but that's how you kind of work these trades. We'll give it a few minutes. We'll give it about 5 minutes, and if they don't give it to us, then we'll go back into the market, change our price, and see what we can do to get our order in. So that is how I do an initial evaluation. I'll take a look at the chart, take a look at our channels. Like I said, technical analysis is not a huge part of what we really do. We're not very good at predicting the future. However, there are trends and there are support and resistance points that you can take a look at to help you kind of figure out where you should be placing your double calendars. It's not rocket science. It's pretty easy to do. All you have to do is take a look at a quick chart, do a quick channel, and you know, that's about it. This seems to be moving away from us pretty quickly. It's up at 501 now, so we'll just kind of hang in there for a while. The prices are moving around quite a bit, and we'll just see what we can do. What we also want to do here is, and I should have done this first, is take a quick look at the volatility levels. The 130s are actually at 40.21. The implied volatility level on the May 150s are at 33.64. If we take a look at our Junes, they're at 39.74. So we're selling a little bit higher volatility here, and we're buying a lower volatility, which is what we want to do. We've got a positive skew, they call it. And at 150, we've got a 33.62. And we've got a 35.66. So we're fine. We should have taken a look at that, but usually with the index options, you don't get a lot of either a large positive skew or a large negative skew on these. They're pretty close to each other, so you don't have to worry about that too much. If we were doing an individual stock, then we would definitely want to take a look at those. And what I mean by a positive or negative skew is, if the front month has a higher implied volatility than the next month or the month that you're buying, it has a positive skew. It's positive because you are selling a higher volatility, and if the volatility should come down, then you are in a better position to profit. A negative skew is if you have a lower volatility in the front month that you're selling and a higher volatility in the next month that you're buying. That is actually not a good position to be in, especially if it's 2 points or more, because what you're doing is you're selling a lower volatility. If volatility should decline, then your position will get hurt. It will not make as much profit, and you could possibly even see a loss on the position if volatility levels should decline significantly, or the volatility levels in the second month that you have your position on increase dramatically. So we're in a good position here. We're just going to wait and see if we get our order filled, and we should be fine. We're going to be putting in some other orders on our test account, and we'll be following those along as well in subsequent videos. But that's where we are right now. We will. I know the EEMs are extremely. They're pretty well traded. Let's just take a quick look at the volume on these. The volume. They're trading a couple hundred contracts. Here's the now obviously someone here is making a bet that the EEM is going to be dropping. Either that or they're protecting their ETF position. It could be insurance on their ETF position if they're buying the ETF itself, the underlying. We've got 2,100 contracts today already on the 135. Let's see what the open interest is. Open interests are quite high, so they're quite liquid. We've got 20,000, 18,000, 44,000, 43,000 on the call side. We've got 17, 18, 36,000 on the put side. So there's quite a bit of liquidity in these EEMs. I like the EEMs for index trading. The prices are quite good. They're a little bit more expensive to buy on a double calendar, but that also means that there's quite a bit more profit potential in these, and it seems to trend quite well. So that's it for today for opening positions. Refer to the TOS, using TOS CD for selection, order entry, help management, for more information on exactly what we did here, because we went through quickly an analysis. We also went through the order entry system, and I want to make sure that you understand everything that we did here, and that's explained in the using the TOS platform. So, hey, trade with confidence, guys, and we'll see you on the next video.